Fed cuts are going to come later, but then much faster than this market has been pricing in. Now, we've already been seeing that later to a certain extent, and that's just simply because we do expect the labor market in particular to decline. We do expect inflation to decline, but we have a few more months before the data will give the Fed permission to begin this easing cycle. What we haven't bought into is that this would be like a 2 or 3 year done situation, that these would be insurance cuts. We believe we are heading into a proper downturn that will require a proper easing cycle. And frankly, that call, is this just, some insurance cuts on the margin, or are we going to see a average historical easing cycle, is far more important than do they go in June, September, or even December in our view.
So your two words are later and faster, basically. What gives you the confidence that we will see a material downturn?
Leading economic indicators. So just about everything in the labor market that explains where we are in the labor cycle is pointing to a deterioration. And we're not calling for the end of the world. We're not saying it's a big crisis. We're calling for 2 quarters of negative GDP, Q3 and Q4. Could be Q4 and Q1. We'll know as we get closer to it. We've got, business employment development data, 9 million companies telling us there were job losses last year. Household employment has been flat. Temporary employment, really good leading indicator, flashing recessions. Average weekly hours worked in the economy. Just how many hours are people working? That's back to pre-COVID levels. Quit rates are dropping. Surveys from PMIs to small businesses say we're just not hiring as much anymore. I mean, I tell my team, we've been calling for a recession for a while. It's been later than we expected, but I say every day, come into work, look at the data, and just ignore your past call. What does it tell you? It tells you we're late cycle, and the odds of a downturn are much higher than the odds of a reacceleration from this point.
We're hearing a similar type of commentary coming out of the Walt Disney Company. I'm reading the research React from Bloomberg Intelligence, Geetha Ranganathan. Disney commentary on a normalization of demand at the theme parks will weigh on sentiment even after the segment posted a solid 12% operating income in fiscal Q2. Guidance for the parks in Q3 is weak with no growth, suggesting full year estimates might be at risk. So there's an example, Francis, of a data point suggesting maybe the consumer's strength is kind of waning here. Is that where you think you might see it from the consumer per se?
You're likely to see it across businesses and consumers because that's how rate hikes work. The average time between the first rate hike and its impact on businesses and consumers is 2 years. So we're not exiting the period in which rate hikes become really impactful in the economy. We're entering that period. The mistake was in thinking that we'd see the impact earlier because of how fast and intense the rate hikes came. We're just entering that period. This is old-fashioned economics. When money costs more to borrow, you borrow less of it and you invest less of it. Consumers can borrow less, they can spend less. Now, I will say there's a really important component here, which is that we are seeing a big bifurcation amongst both businesses and consumers. The spread between CEO confidence and small business confidence, largest that we've seen in this data history. And for consumers, high-income consumers, they feel everything is fine. Why? Because they're benefiting from higher rates and a good stock market. Low-income consumers telling a different story. So I love a good quality stock picker, even as a macro strategist in this type of environment. It's going to be a little bit trickier than just looking at the aggregate. There are some elements underneath the surface that are telling slightly different stories.